we're gonna get started with the S&P 500. Currently we're up 0.62%. Okay, so we're overbought and going down in stochastics. We're like 80 in stochastics. Usually when you're towards the high and starting to go down, that's an indication that we're overbought. And we just went through the July 4th holiday weekend, which we thought would be decent. And okay, let's just look at our calendar here. Calendar, we expected the time around the July 4th holiday to be good, and it was really good actually. We had end of quarter window dressing, and that actually came to pass. And now we're like overbought, so I would expect that the next week or so could be negative for the market. But we do have July as one of the best months of the year. So if you look at this, 0.79% on average. So that's really good, primarily because we have earnings coming out. Every quarter that there's earnings, that's a catalyst for stocks to go up. And we're going to have all the big tech stocks coming out with their earnings towards the end of the month. That's why I have this green right now, because we're just following the stochastics and the chart here. Let's look at the meeting notes. Let's see. Okay, let's look at the meeting notes with our S&P. This is our stochastics for the S&P, and we're at 82 right now. We're a little bit overbought, and we hit the top up here, and there's a very good chance we can get back down to here if we're just following the zigzag pattern. So don't get over your skis right now in buying things and getting excited. Things are going up because we're still kind of trapped into this trading range. Okay, so some of our things to look forward to. Okay, we're in July. We have a Fed meeting on the 26th. Show you the news that came out this morning. Okay. Okay, we had a labor report that came out yesterday, and it was very strong. So that's good news and bad news. It's bittersweet. And good news is the economy's doing real good in that it's supporting a very robust labor market. But whenever you have the labor market doing good, the Fed has to increase rates so that it doesn't get too hot. So there's a good chance. The summary of that article is we have a strong job market. That means the Fed will most likely raise rates and hold rates higher for longer. And that means stocks that need to borrow money, anything dependent on borrowing money to buy something, like the housing market, that's they're affected. Stocks that don't need to borrow money, like all the tech stocks we're following, like the big tech stocks, they're going to be more stable, attractive investments through a period of time of rising interest rates. So that's kind of what happened. So we're going to have a meeting coming up in July 26th, where the Fed's going to most likely raise another quarter point, and it won't be until September. Do you have any comments? Anyone know any comments? Yeah. All right. So September, we're going to have another Fed meeting, and there's a lot of time between now and then to find out, if inflation is going down. But you have to keep these things in mind and how it affects the stocks and we're watching. We expect August to be a bad month because it traditionally is, and September is usually a bad month. So you got to be ready for that as we enter that. We're like super overextended right now. There's no real, in August and September, there are no earnings, and everyone's on vacation, so you have lower volume, and it's kind of things don't pick up until at the end of the year in the stock markets. Okay, so we got that. We're down this week, 1% since last week. We still have over 50% of the S&P stocks over the 200-day moving average. So I have that. You can click on this when you get to the meeting notes. You keep track. Right? It was 67% over the 50-day last week. Now it's 71%. So there's momentum. Last week it was 59% over the 200-day moving average. Now it's 60%. So it's broadening out from the 10 tech stocks that went up the most this year. That's good. That's all good for momentum. So market breadth is still improving. And what other things are important here? Okay, so the 10-year went up and the 2-year went up, most likely because of this job market. Whenever you have a strong economy and it's overheating, the Fed has to raise the rates. And that's why this went up so much. And whenever rates go up, that's not good for the general market in general. Okay, now let's look at some more things. What are the things we have to look forward to? I have the key down at the bottom here. In July, there's basically nothing going on. We have a holiday in September. That's Labor Day. And then we have a holiday. Next holiday is Thanksgiving. So there's not many holidays in July after July 4th. So, yeah, that's good. That's the big picture. Let's look at, we already talked about the S&P, and it looks like it's overextended. Might go up to here, might go down to here. We don't know. Crude oil is up a little bit. Inflation is still around 4%, and the dollar index is about the same, down a little bit. Gold is unchanged, and we don't have really. I think in general the consensus is that the economy is getting better around the world. That's why the oil market is picking up in price. Let's look at the fear and greed. We're still in extreme greed. A little bit less greedy than last week, but still, people are just in momentum, fear of missing out market. And we started just this week to feel the sense of fear. You can see in the VIX, it's up 5% yesterday. And you can see it's in a downtrend. That means over time people are getting less fearful. And whenever the fear gauge is down here, that's when people are super aggressive and fear of missing out. When it's up here, people are fearful. So it's looking like this rally could continue unless we have like an existential crisis we don't know about. The dollar's continuing a downtrend, so that helps. That's a positive for stocks that are multinationals, and it's good for commodities. So any kind of commodity, most commodities in the world are based on the U.S. dollar. As the dollar goes down, like gold, the price of gold will go up. It's a one-to-one correlation until Brazil and all the other countries start pricing commodities in non-dollar denominations. All right, so let me see what else is happening here. Okay, let's review the emotional gauge. We're still at extreme greed. So people are still in the phase of, fear of missing out. And we had a little surprise, with inflation and the Fed this week, but in general, people are still pressing the button to buy things. And I'm guessing in 2 months we'll be at capitulation or fear, because that's when the bad time of the market is. All right. We already talked about this. We had the front page story on Yahoo Finance was about the labor report. There's another labor report that came out today. One was yesterday, one was today. The job report comes in cooler than expected. That's good. Yesterday we had a hotter than expected job report, and today it's cooler than expected. That's why the stock. That means the Fed may not raise rates as much. So there are two conflicting reports, but that's helping the stock market now. Let me see. Here's a little interesting story. Threads rollout proves Instagram is Meta's future. So basically, Meta is making a competitor to Twitter. They already have like 40 million signups, and that's really bad for Twitter because um, Facebook is known for allowing you to speak your mind without a whole lot of um, banning people and a lot of negative, um, not allowing you to post things. But Meta is actually rolling out the same exact product basically as Twitter, and that's going to allow them a different source of revenue. Any comments on that? So we're going to talk about a little bit Meta later on, but they're up like 150% this year or something. So it's I stayed invested in it when it was down because I believed in, if they changed their name to Meta, and they were doing a lot of research in metaverse, they would, if they could be the top of that category, then that would be great. But they also have, the existing business that's very profitable, and now they're just adding new products, and this is their newest offering. So let's see how that over time helps their earnings projections. I'm not sure how it'll affect it, but we'll see over time. We'll compare. Let's see what else is happening here. Hold on. Let's see. There's an article on 7 of the top valuable stocks are still cheap. Okay, so the market value is what they're looking at. So what I did was I compared. It's very interesting to hear these experts kind of say, these big stocks are still undervalued, and let's look at each one of them to see, why they would say that. I put the article actually has this little chart, but I put a little chart next to it, what the PEG ratio is. That's an easy way to figure out if something is overvalued or not. If you have a under 1, it's undervalued. If it's at 1, it's fairly valued. And they actually said Visa is a 11% upside, and according to the PEG ratio, it's like 50% overvalued. Some of the reasons why Visa is down right now is they're talking about possible rules that they have to share their revenue with other companies like American Express. Their processing has to go through them, but the processing of the payments might have to be forced to go to other people, like they did Baby Bell whenever they split up the phone companies. But even with that overhang, it's still they say it's 11% upside. So for me, when I hold Visa, I actually bought it at its IPO, and I've held it even when people were telling me to sell it. But I've been holding it because the stock is, there are more transactions. There are like 80% of the transactions in the world are cash, and as Visa grows, they're going to take over that market share and grow in those countries that don't, or the places that take cash right now. So let's look at Amazon. Why, even with a PEG ratio of 5, that's 5 times overvalued. So they're only growing a small amount, but their PE is like 50 or so right now. Perhaps because they have a moat that no one can catch up to, like to be able to deliver overnight or in 2 days, anything. And they're probably the biggest retailer now. They just overtook Walmart. So they have powers of scale in negotiating contracts and stuff like that. And they're expanding into different things like healthcare and other services. So I'm still holding it as like one of my biggest positions. But it's really hard for me as a fundamental person to accept the PEG ratio of 5 for a stock, but it's always had a premium. Johnson & Johnson, they say it's 10% upside left on the stock, but it's, the PEG ratio is 1.44. So it's 40% overvalued. But I think what they're saying in this article, or Johnson & Johnson has like a very consistent earnings profile. So they're consistent, and you pay more for a car that starts every day. So I think and they pay a dividend too. And for our purposes, we'd be interested in it because it pays a dividend, and over time it grows. But they still have this lawsuit for the telecompiler that could bankrupt them basically, and they haven't determined if they've fixed that problem yet. The Google, it says its upside is 10% from where it's at now. So they must be giving a certain amount of value to its consistency, because it always, for the past 10 years, been growing at 10% or more, maybe now 15%. But its PEG ratio after it went up like 50% this year. So it's 40% overvalued right now, but 49% overvalued. So I'm just looking at these, and their numbers don't match the numbers that I have. I tried to do it, 1-to-1 correlation. But I guess the big part of this is they also realize that Tesla, Meta, and Apple they say that they're overvalued by 2%, 4%, 23%. So sometimes whenever you read articles like that, you still have to do your own research and say, does it really make sense to me? And right now, this guy's numbers didn't match mine. Anyways, any questions on that? Great. Okay, let's look at Visa, because it was one of these stocks that they said was 11% upside. We're going to look at that and see, like, the forward PE is 23, and the PEG ratio is 1.49, and the profit margin is 50%. This is really hard to come by. Profit margin, that means they're a very efficient company, and their return on equity is 42. So what I want to do right now is, we do this like once every 2 months or something, is to review what's a good growth stock. This is my theory. It doesn't mean it works every time, but this is what I try to follow. So Peter Lynch, the guy that wrote a couple of books on the subject, he was the I think he was the guy that ran the Magellan Fund. He said this is his favorite chart that he uses. It's from E-Trade. It's the earnings estimates chart and past earnings. If you can see these bars of the estimates going up in a straight line, that's what you're looking for in a growth stock and for a buy and hold. So you in the earnings estimates, in the future are going up in a straight line. And if you divide these numbers by these numbers, you get the year-over-year percentage growth of the earnings. And that kind of gives you a rough estimate of how much the stock is growing. And the other things I look at are high free cash flow, and low debt, and we have annual earnings in a straight line. I just said that. PEG ratio, you have to be reasonable. Like Amazon right now is not reasonable. Try to buy them when the PEG ratio is less than or equal to 1. And if you end up buying one for more than that, you have to look at its history and see what it's traded at a premium before, and then if you're buying an okay price. And return on equity, we like it greater than 10, and we want the company to have a competitive advantage, and a dividend is always nice to add to the total return. So if you have a 10% earnings growth and you have a 2% dividend, that's a 12% total return in general. So little or no debt and good management. That's kind of
I get your coffee.
I missed that. Say it again. I missed that. I can't hear your.
Yeah. Maybe he's just off mute and talking to someone else.
Maybe that's it. Okay. So let's go to the next session here. Okay. All right. So these are the numbers. This is Yahoo Finance. I look for large market cap companies over 100 billion because they're a little bit more reliable. Look at the PE ratio, the PEG ratio, and the profit margin, return on equity. These are all like super important things. When you look at the debt and you compare the debt to the total market cap, and if it's a large portion of the market cap, and you subtract the cash, the debt minus the cash, if that is a large portion of the market cap, they could have problems borrowing money and growing in the future because of that. So, but I do run, I also want to review stochastics. This is like, it's an art form. It's not science. But there's a lot of people, enough people to follow it, that it turns out to be true a lot of times. So we have, we look at this chart every day, every time we get together. This is like an S&P chart. And usually we like to draw a channel, where this stock is confined to. And it's a good time to buy stocks whenever it's at the bottom of its channel. I marked in with X's in this chart. And either sell or don't buy whenever, a stock or an index is at the top of the channel. And whenever, this is the stochastics part of it, whenever the stochastics, when we're oversold, that's the time you want to buy or establish new positions. And whenever we're overbought, that's the time you want to sell it. You try to time whenever you're selling or not buying to whenever both of these are hitting at the top of the channel and at the top of the stochastics. And you want to buy whenever we're at the bottom of the channel and we're oversold. That's pretty simple, but that's kind of what I followed, and it seems to work a lot of time. But whenever we're in a market correction, or whenever we get out of this range and and the stock goes, or the index starts going down here, it's every man for itself, and you can throw away all this stuff and it doesn't work. So you just have to keep everything in context with this trading range. So where are we? So I did a scan. Fidelity has a scanner. So I did a scan of, I do this every month or so, or maybe 2 times a month, maybe to get some ideas. And we see a lot of the same stocks in our top 10. I do this. This is my criteria here that I'm following. A lot of times I just want to be able to have that item in table. So I put it like a return or PE greater than 0. And so at least I have a PE in the charts. But so what I did was I highlighted, it's like popcorn. You look at some of the stuff that pops out at you as the most important thing. And PEG ratio is pretty important. That gives me, if it's under 1, that gives me an idea that it's growing. It's growing like at 25, and its PE is 12. That's an example of having an undervalued stock, and then you can go and research it some more. So I looked at a couple of these, Deere, the Goldman Sachs. Let's look at why each of these stocks might be have a low PEG ratio. T-Mobile, why would it be down now? There was that news article on Amazon maybe muscling into the phone market. So T-Mobile was down 10% because of that, but it was a fake story because they're just going out of business. And Amazon said they wouldn't buy the stock. They wouldn't be interested in that. Deere, why they had a PEG ratio of 1. After the Ukraine war, there was a huge run-up on the stock because potential, everyone wants to get into agriculture to make their farms more productive because of the Ukraine situation of not exporting a lot of grain. Maybe that was a lot of times people buy a lot because of that news story, and then now there's not that news story anymore, so it's not as sexy of an item to look at. Goldman Sachs, during the pandemic, we didn't have any IPOs, so they had a huge lull in IPO activity. Now they're starting to pick up, so and they're getting out of some unprofitable businesses they started to get into. Like they were issuing credit cards and personal things for regular people, and that wasn't very profitable. Selling that off, and maybe that's why they're not selling at a premium right now. And I found this other one, PVD. Looks like very interesting numbers. Look at this. Their return on equity is 33. Wow. Forward EPS is 20, and revenue growth is 30. I said that has some big numbers I want to look at. So we're going to look at that a little bit later on, just because it'd be interesting to do that exercise. Okay, let's go back and okay. So first of all, PDD, it's a smaller stock to begin with. It used to be called Pinduoduo, and it's an e-commerce platform. So it's basically provides services, and they sell different things. It's basically there's a Temu marketplace, and it's like it allows people to buy and sell things online. It's very similar to Shopify, or a company that does that, connects buyers and sellers and allows people to do that. So now that's I can see that's electronic. You can scale the company by putting more servers out there, and that's kind of efficient situation. So you see, they changed their name a couple times, and they're based out of Ireland. So they have a decent cost structure for their taxes. That's probably more efficient than being an American subsidy. Now let's look at their valuations. The forward PE is 17. PEG ratio is less than 1, according to Yahoo. So that confirms it's undervalued. The profit margin is great. It's 25. We want 13. And the return on equity is 36. And we like something over 13. So that's looking good. Now the other thing is their debt, their total cash. This is amazing if it's true. They have 157 billion. It might be an error in cash. That's more than Apple, and their total debt is 16 billion. So that can't be true. Their total market cap is 89, and their total cash is 157. So they're selling for less than their cash. That's weird. This number is probably wrong, but in general, that company doesn't have debt. That's why we did that little exercise. So it looks like it's a decent company. Let's look at their earnings summary. Okay, so I did the comparison year over year. Last year to this year, it's grown 12%. And then the next 2 years, it's 20% or 18%. So they have a PE of 18, growing at 18. That means they're fairly valued. I didn't see anything really exciting about this company. A lot of times when you have smaller companies, you have to really dig into it to know they have a moat or competitive advantage. And my initial research didn't tell me they had like a competitive advantage. They have so much competition, like Shopify, and we were looking at Clover, all these other fintech companies that are competing with it. So it seems like they could be growing at 18%, but they really have a moat, and they don't need to borrow money. That's good. This would be the kind of stock I'd keep track of, and on a market sell-off, I know it's growing at 18%, and I'll get it for half off or something like that. So I'll keep my eyes on this. I'll keep a bookmark, and whenever it does go in half, a lot of times the stock that's smaller, that's we might be able to get a stock like that's growing at 20% for like half off. And it is until you do this screening that you see the potential in a stock like this that you've never heard of. Okay, for me, I'd rather have if I'm buying a position in a smaller company that's not established, doesn't have a huge history. You see, there's a lot of inconsistencies right now because they're growing a company. They have a negative earnings here, so they have a lot to work through before they're they can demand a premium multiple. So I would be interested in this in the next market sell-off. Maybe it goes down in half. So I'm sure that'll happen. We'll watch it. Let's look at what's going on today in the stock market. Hold on for a second. It'll be worth it. Okay. Okay, oil's up big today. Mark said that Albemarle is out. This is a lithium mining company for the most part. What else is coming up? We had a news story this week about China and the United States. They're like tit for tat, doing sanctions and banning imports of things. And there was a news story that China was going to ban some kind of. They were going to start banning possible rare earth licenses to sell to the United States. So it looks like the United States is going to have to invest in rare earth and/or lithium projects, things that China normally exports. So that could get a lot of those kind of stocks excited in price. So we see, what's the theme here? A lot of oil is up today. We have Halliburton is oil company. They do pumping of the oil. Diamondback Energy is they do the actual exploration and drilling. We have Zions, they're a bank company. APA is another oil company. Phillips Marathon. Okay. So the price of oil must have gone up in a major way for some reason. I don't know why. Let's look at that. Look at the price of oil. Okay, let's look at the pricing. Anyone know why oil would be going? Look, it went up 2% today, the price of oil. Maybe because the payroll numbers came out yesterday, and that was better than expected. That means the economy is doing really good. When the economy is doing good, there's more demand for oil. And perhaps whenever the global economy is recovering and there's demand for oil, the price of oil goes up. That could be. That's the only thing I can think of. Let's look at let's look at the sector ETFs. One's doing the best are oil, mining, metals and mining, and we mentioned why metals and mining would be going up, because America might be investing in supporting all of the manufacture of rare earth and materials that China might be banning. What other things might be? And the dollar, let's see if the dollar is going up or down. US dollar. Okay, he's going down again. Okay, so it's going down. Okay, let's look at what else is happening here. Energy. Banks are going up. They were down yesterday. So whenever whenever there's a good job report and it's a strong economy for the United States, the rates went up a lot yesterday because of that news story. Today we had the opposite. We had a cooler job report, and that made all of the interest-sensitive industries go up because there's not a fear of raising rates if you have a cooler job report today. So it's all over the place with these. But the reason I'm saying all these things is interest rates have a lot to do with the price of stocks and why they go up and down. So let's look at what else is going on here. Things go to being the worst are the consumer staples, healthcare, biotech. Those are safer industries. And okay, that's what we can get from that. Let's look more at what's going on with market movers. We already talked about this screen. What's doing the worst? But wow, every stock in this is health companies. we had a couple approvals, like Biogen had an approval for their Alzheimer's drug today. Why would it be down? I don't know. But these are all very conservative stocks that did really good last year, and now they're out of favor, it seems. All right. So let's look at what else is happening with the top gainers in NASDAQ. So we have oil producing companies. Enphase. Why is Enphase up? Other than it's volatile.
Because it's a wonderful stock.
Right. right. You see it. Yeah. So do you have any ideas of why Albemarle is up today? Your lithium stock.
Okay. No, I didn't get a chance to look, but I guess would be some sort of deregulation, but very often things do, but I haven't looked to see why specifically today.
One of the biggest problems with manufacturers of rare earth minerals and other items in America is there are so many regulations that it prohibits basically the manufacture of those items in America. For instance, the rare earth minerals, there aren't any new plants to process those in America because it just wouldn't be environmentally safe or whatever. So they don't allow it. So that's why, and if you can buy them in China for less, then there's no use even making them. So now, like you said, regulation, if there was talk of deregulating that industry, allowing people to make these rare earth minerals aren't that rare. They're just called rare earth. But the processing of the rare earth minerals is rare in America, and no one really does it. Only China does that right now on a major scale. So that maybe that's going to be coming to a fruition in Congress pretty soon, that we need to be self-sufficient with these important minerals. So what else is happening here? We have NVIDIA. Cool. So we have a lot of the chip stocks going up. Not sure why that's happening. Biogen, Vertex. Okay, I don't know why these are all conservative stocks that were stable last year when all the tech stocks went down 30%. Now they're turning to be out of favor. But for me, I'm still holding my Pepsi and some of my other, like Eli Lilly. I'm not going to be selling those because I know they're like a total return for me. They're not like a true growth stock. They're kind of going up every year. Let's look at what the Dow is going up and down. Oh, drug stocks in the top 3, top 2, and then we have United Health. That's a health company. These are all conservative stocks.
My Merck is hurting. Yeah.
Why do you like Merck?
Oh, I inherited it.
Okay.
And just hung on to it.
That's cool. Merck is let's look at Merck just for fun. It's good. It's down 2% today. So they're a diversified manufacturer of pharmaceuticals. We know that. Let's look at what dividend they pay and see if they're growing at all. We got to do two things at once. I'm always looking for something for my dividend part of my portfolio and to diversify, because I'm like 90% in tech right now. So it's always interesting to see if there's anything when a stock is in its top 10 going down. Let's look at their Let's look at the chart where it's at now. Almost every drug stock is in a downtrend right now. You can see that it's reaching the level of support that it had a couple times going back to May this year. So there's a chance it'll bounce from where it's at, like very close to here, because it's right at that level. The next level of support is like right here, and then maybe right here. Let's look at the statistics for Merck. They pay a 2.57% dividend. That's really good. They might be down because this Alzheimer's treatment was approved for Biogen. They might have like some kind of competitor to that. I don't know. 4P is 16. PEG ratio is 1. So it's pretty fairly valued. These numbers right here are really good. Okay, so it's basically fairly valued. We're going to look at it to see if it's actually growing at all. Okay. I guess you would call Merck like a total return, because you have 2.5% dividend. Wow, that looks really good. They didn't grow from last year to this year. It's actually negative. It's 7.48 to 6.99. Let's look at the numbers from this year to next year. 6.99 divided by 8.50. That's 18%. 8.5 divided by 9.61. That's 12%. 9.615 10.7%. So if you put it all together, they're growing like 11%, let's say. So if they're 11% growth and their PE is 16, but yeah, that makes sense that it's a PEG ratio of 1.33. So it's actually growing at like 12%, let's say, plus a 2% dividend. That's like a 14% total return. This is a really good stock. I think that's what I would seriously look at, buying and holding. Is like the great thing about having a stock like this is you would have consistent growth over time, even if it's 8 to 10%, and you get paid a 2.57% dividend. It could be growing. So and this is a stock I would like keep on my marker as it's a decent stock. Whenever there's a sell-off in the stock market, then I'll look to try to get it on sale. Right now it's a little bit overvalued, like 13% overvalued. A lot of the drug stocks are out of favor right now. So you have an industry that's out of favor, and you have a stock that's still growing like a 10 to 15%. So that's a really good excursion. Glad we did that one. Let's look at other market movers that are down. Merck, and so across the board, you have all the major drug stocks going down. It's probably people are this fear of missing out. Whenever stocks are going up, it's really hard to fight that. Right now we have this S&P. We're gaining momentum. Everyone sees that, and I think that fear of missing out is what's causing people to jump on the bandwagon. It isn't until we have some kind of bad news from the Fed or something like that they'll squash it. But for me, I'm looking at the big picture, like not this, but I'm looking at going back to 2012. You can see that there's a straight line up. It just you gotta kind of ignore these downturns. You gotta know that when I'm investing, I invested back here, so you have to be willing to go through these little bumps in the road to achieve where you're going. And if you hold a stock or an index, then it's a good one then it follows the rules we're looking at. There's like a greater than 50% chance over 2 years that it'll be up. Then if you hold it 5 years, it'll be a 60% chance of going up. And if you hold it for 10 years, there's a good chance that you'll be, positive. You'd make money like 80% of the time. So that's kind of the way I'm thinking about it. But it's kind of fun to be able to look at it short term and pick your positions while you create new positions. All right. So what else do we have to say? Hold on. Let me look at some more of our current events here. No. Okay. What else is happening? Are there any stocks that you wanted to go over, Mark?
No.
No? Okay.
No.
How about we go over Albemarle? Because the good thing about that stock is they're a dividend aristocrat.
Indeed.
That means yes. That means they it's an interesting industry to be a dividend aristocrat. A lot of times you have like this company is like at the mercy of the price of the commodity that they're producing. So it's really hard to consistently raise your dividend over time with such a volatile type of stock. Look at this. This is interesting. They're projected to their earnings are projected to go down this year to next year. Let's look at that. So from last year to this year, there was a huge 21.96 divided by 23.09, 5%. They went up 5% since last year. Their earnings 23.09 divided by 21. They're down 5% from this year to next year. So 21.97. They might be investing. They're growing 3% from 24 to 25. So 22.60 divided by 27.1. Then they're growing 17% after that. So it might be, I'm not following the stock very much. They might be investing this time, and then once they have their mines going and their investments going, they'll be growing 13% after that. So I think Warren Buffett would prefer a stock that grows at 10% consistently over time, or pays a dividend consistently. But I guess look at this, how the earnings are going up in a major way in this year, and then they're down again. So I think could that be because of the price of the commodity? I mean, or is it their techniques in mind? You know what I think it is? Remember we saw that one story where they were closing down some of their mines they're nationalizing some of their mines in another country. I think that's what it was. That's why they were down so much. So they basically lost a huge part of their capacity. So that's why they might be only growing a certain amount. But that's an example of, this business model might not be as robust as a Coca-Cola or a Procter & Gamble that has consistent sales over time and, consistent manufacturing that gives them the reliability. So anyway, I'm surprised that they have they've grown their dividend over time. I guess if you're committed to that, returning to shareholders, that's always a good sign, but this is a little bit too inconsistent for Warren Buffett, I think. Because although Warren Buffett likes oil stocks, and they're super volatile. All right, that was good. That was a good little exercise. You see, let's pick one more stock to go through, and that'll be calling it a day. Let's look at the market movers. Let's look at these are all stocks that were doing really good last year. Let's look at the stock that's Zions Bancorp. All the banks are at the mercy of this interest rates. So whenever the interest rates go up, the banks go down because of they're stuck with a lot of these long-term bonds that are worth less as interest rates go up. So if they're stuck holding a lot of those bonds, they're going to go out of business. So let's look at Zions Bancorp. This is the stock that got caught in the There it is. There's the huge swoon from the problems we had with the regional banks this year. It went down as low as 24, 22. Now it's up at 29. So you can see that during the pandemic, they went down to 24. That's the same price it went down to the worst of this panic for the regional banks. So there is support at 24. So if I was interested in getting this, I would know that even if I got it here, pretty much they didn't go out of business. They probably would, the lowest they would go is 22. That's like almost like a put, because you have prior level of support there. That goes back, what goes back even further, it goes back further to 2016 when they had a low then. So as past levels of support, people look at that, and that kind of determines where it goes when it crashes. So I don't know anything about banking, so I can't really go look at a peg ratio of this stock, because banks aren't you don't look at banks that the same way, because they have a different business model than the growth stocks that I'm looking at. They have to borrow a lot of money in order to lend the money, and you can manipulate the numbers. It's not easy. So let's look at Zion, just the numbers. Okay, so the P ratio is 4. That is super low. So they're not getting any love at all from the stock market. And the forward dividend is 6%. That's pretty amazing. Let's look at the statistics. So they're undervalued by 30% according to Yahoo Finance. So they have a PE of 5. So that means they must be growing around 8%. And these numbers look decent. Return on equity and profit margin are great. So is this like a baby that's thrown out the bathwater? I don't know. Let's look at the forward annual dividend rate of 6%. That's pretty amazing. Let's look at the E-Trade to see if it's actually growing or if it's not. Look at Zion. Now, the one thing we're not doing here is we're not looking at their balance sheet to see if they have any long-term bonds on their balance sheet like Silicon Valley Bank did. That's we're not a banking analyst. We just look at, we just look at the numbers. We know that's really not good. So they're not growing at all for the next, they lost, their earnings declined from last year to this year, and this year to next year it's declining some more. So basically what's happening is as interest rates go up, they have to pay more for people to keep their money in cash, to keep their deposits in the bank, and they're going to be losing money doing that. So I don't know when that ends, but that's something I don't understand, and it's probably not worth messing around with. But that's a good little exercise we did there. No wonder it's going down today. It's going up today because of the interest rates, but no wonder it's so volatile, the stock lately. All right. Okay. So I think that's all that I have for today. If you have any questions during the week, let me know, and I hope you have all